Good day fellow traders and value investors, and welcome back to another video. Today we continue our series Start with the A's. And we're looking at Ralph Lauren. Over the last year, Ralph Lauren's share price has more than doubled, whilst revenue has barely moved. If revenue hasn't grown much, why has the stock more than doubled? And what is the market actually pricing in? Let's have a look. Ralph Lauren is a global premium luxury lifestyle brand spanning apparel, accessories, home and fragrances, with a strategy that's less about sell more units and more about sell the right product at the right price through the right channels. Ralph Lauren sells through three main routes. First is direct to consumer or retail. It is its own stores and its own website. This is the highest margin channel and gives the company full control over pricing and brand image. Second is wholesale, selling through the department stores and select third-party partners. This provides scale, but management has become much more selective about where the brand shows up. And finally, licensing, where partners produce things like eyewear, fragrances and home goods, and Ralph Lauren earns royalties. This mix allows the company to grow without needing to own everything directly, which supports margin and cash flow. Now let's talk about growth. At Investors Day, management laid out a strategy they call the next great chapter. The goal is mid-single digit revenue growth combined with operating margin growth. In simple terms, they are saying we'd rather grow steadily and become more profitable than grow fast and damage the brand. That one decision explains almost everything you see in the numbers. Over the past several years, Ralph Lauren chose quality of revenue over quantity of revenue, and that choice was intentional. Since around 2018, management stopped chasing low quality sales. They cut back on off-price and discount channels, closed underperforming stores, reduced promotional intensity, walked away from some wholesale doors, raised prices and pushed full price selling as opposed to finding their products in the discount bins. Every one of those decisions suppressed revenue growth in the short term, but that's not a mistake, that's the strategy. So Ralph Lauren didn't grow by selling more, he grew by selling better. And that distinctions matter, especially when we start talking about valuation and timing. Now let's have a look at the financials in TradingView. First I'd like to look at the price. Stock price in about 2018 was $70-80 and it's grown to $363. If we look at the revenue, we've seen that there was steady growth over the last few quarters and double-digit growth over the last 4 or 5 quarters. Does that justify the price increase? Let's have a look on the annual. We see that the revenue has grown from 6 billion to 757. That's not quite 4 or 5x revenue growth like the stock price. So what happened there? If we scroll down to the net income, we kind of get a little bit of a clearer picture. We've seen that net income has increased from 430 million to about 854 million. It basically doubled over since 2018. And what happened is Ralph Lauren has focused on selling their products at full price. They closed some unprofitable stores and they did that to improve their gross margin and the net margin. Now we've seen that that's improved. They focused on selling less product at better prices than selling more products at lower prices, making less profit. And I believe that's what the market is pricing in. Have a look at the balance sheet. We see that they have a healthy cash position as well of about 2 billion cash and short-term investments, and the total debt sits at 2.67 billion. I'd say it's pretty manageable. Let's switch to statistics and look at the annual. We can see that the company is currently selling for a PE of 26.48 and it's been selling in the past for a PE of 14.15, and that's important for our valuation. I use a PE multiple of 16 for my bear case scenario. Then if you look again at the gross margin and the net margin, we can see that the gross margin has improved from 57 to 65 and is sitting at about 67-69 for the latest 10 Qs, and this is giving us a clearer picture as well. It's showing that management is focused on the gross margin, on improving the brand, on selling better quality rather than higher quantity. Net margin growth is not massive, but it shows us that management is focused on delivering on their strategy. Current ratio of 2.04, that's telling us that the company has $2 of current assets for every dollar of current liability. They'll have no trouble paying their suppliers. Debt to equity is pretty high of 1.11, it's a bit higher than what I like it to see, or 0.5 maximum. So there you have it, we've seen the growth in the net margin, but how much of that improvement is already priced into the stock? Let us look at the intrinsic value using the three calculators first. Warren Buffett, Phil Town and Peter Lynch's calculator. Warren Buffett's calculator is using book value per share, the growth over the last 10 years, and is comparing that to the 10 years notes. and takes into account the dividend and the dividend yield. According to Warren Buffett's calculator, the stock should be valued about $68.82 per share, overvalued. Using Phil Town's calculator, we are using a growth rate of 10.50, and that was the consensus when I was researching about the company's growth over the next several years. The management themselves are aiming a growth of between 6 and 8% over the next 3 years till 2028, so it's pretty optimistic. And using that calculator, we get a stock value of $121 per share, overvalued as well. And likewise for Peter Lynch, we get an overvalued rating, and Peter Lynch's calculator is using PE growth. So there you have it. Using the three calculators, we get a range of between $68.88 per share to $121 per share, way below what it's currently selling for. And for the 3 case scenarios, I use the full price demand plus pricing power as the key drivers. And I use these PEs because PE of 16 is roughly the market or slightly below for consumer cyclicals during downturns. PE multiple of 20 because many brands are trading between a PE of 18 and 22 and reflects steady growth and quality earnings. And then PE of 24 because luxury and premium brands with durable pricing power often trade above normal cyclicals. So in a bear case scenario with EPS growth at 4%, consumer spending weakens, discounting creeps back in, margins shrink and EPS growth slows, we could see earnings per share of $16.47 in 5 years, and the stock could be selling for $263.58 per share. With EPS growing at 8%, the company meets expectation, EPS grows roughly in line with analyst forecast, pricing power holds and margins stay healthy, we could see earnings per share going up to $19.89 in 5 years, and the stock could be selling for $397.89 in 5 years. In a bull case scenario, with EPS growing at 12%, brand momentum accelerates, global expansion works even better than consensus, pricing power is rock solid and earnings grow strongly, we could see earnings per share of $23.86 in 5 years, and stock could be selling for $572 in 5 years. Putting it all in a probability weighted table, we can see that we can get about -27 return in 5 years in the bear case scenario, an increase of 10% in a base and 58% increase in the bull case, with a total 5-year return of 12%, making it compounded annually 2% 35. Adding 1% dividend, we can see that we can get just under 5% from Ralph Lauren if we buy it at current prices and hold it for 5 years. So there you have it. The growth is already priced in, and according to these 3 scenarios, there is not much return from the stock. Under 5% is just in line with the savings account. Even great businesses can be bad investments if you ignore what could go wrong. The biggest risk for Ralph Lauren is demand and macro risk. This is a premium discretionary brand. That means in economic slowdowns or recessions, people delay non-essential purchases, retailers become more promotional, and pricing power gets tested. Even strong brands feel this pressure. The second major risk is promotion and inventory. Fashion isn't forgiven if you get demand wrong. If Ralph Lauren overestimates demand, inventory builds, discounts increase, margins get hit. If they underestimate demand, shelves are empty, sales are missed, momentum slows. Either way, execution matters. Ralph Lauren also calls out risk from tariffs, supply chain disruption, shipping constraints, and geopolitical events. These costs don't always show up immediately, but when they do, they often hit gross margins. None of these risks mean Ralph Lauren is a bad business. They mean this is not a set it and forget it stock. I'm looking at the weekly chart using a 34 and 55 EMA crossover combined with Alex Piroglu MACD for momentum confirmation. On the weekly time frame, Ralph Lauren is in a clear established uptrend. Prices away from EMA 21, 34 and 55, and we can see that moving averages are pointing upwards. We can also see that every pullback has been bought. This is the tariffs conundrum. I struggle to draw the levels because every time the stock pulled back, it pushed through the levels and it continued upwards. We can see on this portion as well how it's been going steadily up. We'll zoom out a little bit and we can see in this period the stock has been moving sideways between a low of 50 and high of about 100. It was a strong support and resistance area, and it was during the time when they were executing on their strategy of improving the brand and improving the gross margins. As soon as they started delivering, as soon as the results started showing up in the net margins and in the margins as a whole, we could see how the stock has exploded and has moved upwards. Long 1 and long 2 have printed in 2024, 2023 even, and then it continued from there. You could track the stock with the ATR. You can also see that the average true range dots are printed below the stock charts, and they are currently going between the moving averages. If we look at the momentum as well, we can see that the MACD and the signal line are about the 50%, which tells me that the momentum is still strong, is still behind the stock. But as we look backwards, we can see that the momentum is not as strong as it was before. It was in the overbought area and it continued from there still. It got sold when it pulled back, but we don't see the same momentum in the last several weeks. So as we can see, the trend is still up, but risk reward for new entries is worse at these levels in my opinion. So let's bring this together. Over the last year, Ralph Lauren's stock price more than doubled while revenue grew by only about 10%. That's not an accident and it's not speculation either. What the market is actually pricing in is continued execution. Management chose quality over quantity, protected the brand, expanded margins and returned cash to shareholders. That's why the stock moved the way it did. But at today's prices, it's not a classic buy it and forget it stock. The fundamentals are strong, the trend is intact, but the valuation and timing still matter. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing and let me know in the comments below what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.